If you're investing for the long term, advises Boston-based O'Brien Wealth Partners Director of Research and Certified Financial Advisor Austin Litvak. Some things happening in the market now are unprecedented in history, but that won't remain forever. The Federal Reserve is still dependable and will bring inflation under control, according to Litvak, if you're a long-term investor. It's fair to be concerned about your assets, particularly in light of the recent sharp declines in the stock and bond markets. And starting an investment portfolio at such a volatile period might be unsettling. However, if you choose an investing strategy that is suitable for your own financial circumstances, time horizon, and asset allocation, you won't lose out on any future rebound. Here are the top 10 biggest investing opportunity. Before starting, don't forget to like and subscribe to our channel for more future updates. So let's start. Number 1. High-yield savings accounts. Higher rates of return are offered by online savings accounts and cash management accounts than by regular bank savings or checking accounts. Cash management accounts resemble a combined checking and savings account. These accounts often come with debit cards or checks and may provide interest rates comparable to savings accounts, however they are primarily offered by brokerage companies. The greatest savings accounts are for short-term investments or money that you only infrequently need access to, like an emergency or vacation fund. 6 withdrawals from a savings account are permitted each month. Accounts for managing cash flow provide additional flexibility and, sometimes, higher interest rates. Number 2. Certificates of deposit. A federally insured savings account with a set interest rate for a certain time period is known as a certificate of deposit, RCD. A CD is for money that you are certain you'll need at a certain future period, a home down payment or a wedding. With typical terms of 1, 3, and 5 years, CDs could be a smart choice if you're looking to securely grow your money for a certain purpose within a defined time period. However, it's vital to keep in mind that you'll probably have to pay a charge if you want to withdraw your money from a CD early. Don't put money you could need soon, as you wouldn't with other investments, in a CD. Number 3. Money market funds. Money market mutual funds are a kind of investment, as opposed to money market accounts, which are savings account like bank deposit accounts. Your money purchases a collection of high-quality, short-term government, bank, or corporate debt when you invest in a money market fund. Money that you're prepared to expose to a little bit greater market risk since you may need it soon. Money market funds are also used by investors as a holding container for cash designated for future investments or to store a part of their portfolio in a safer investment than equities. Although technically an investment, money market funds won't provide the greater returns and higher risk of the other options on this page. Growth in money market funds is more comparable to rates on high-yield savings accounts. Number 4. Corporate bonds. The main difference between corporate bonds and government bonds is that you are lending money to a firm rather than to the government. Since the government does not guarantee these loans, they are a riskier choice. The risk-return profile of a high-yield bond, sometimes referred to as a trash bond, may actually be far higher and more similar to that of stocks than bonds. Investors who are ready to take on a little bit more risk in exchange for a fixed income instrument with possibly better returns than government bonds. In the case of corporate bonds, the yield increases with the probability that the firm will fail. In contrast, the yield on bonds issued by established, major corporations would often be lower. The investor is responsible for determining the risk-return ratio that works best for them. Number 5. Mutual funds. In order to purchase stocks, bonds, or other assets, a mutual fund collects money from investors. Mutual funds provide investors with an affordable opportunity to diversify, distributing their money over a variety of assets to protect themselves against the losses of any one investment. Mutual funds are an easy method to access the higher investing returns of the stock market if you're saving for retirement or another long-term objective without having to own and maintain a portfolio of individual equities. Some funds restrict the kind of businesses they may invest in to those that meet certain requirements, such as biotech firms in the technology sector or businesses with strong dividend yields. This enables you to concentrate on certain investment areas. Number 6. Index funds. A sort of mutual fund known as an index fund owns the equities in a certain market index, the S&P 500 or the Dow Jones Industrial Average. In contrast to an actively managed mutual fund, which employs a professional to choose the fund's assets, the goal is to provide investment returns similar to the performance of the underlying index. Some of the finest investments for long-term savings objectives are index mutual funds. Index mutual funds are less volatile than actively managed funds that aim to outperform the market, in addition to being more affordable owing to reduced fund management costs. Number 7. Exchange-traded funds. In that they pool client funds to purchase a variety of assets, exchange-traded funds, or ETFs, are similar to mutual funds in that they provide a single diversified investment. The way they are offered is different. Investors purchase shares in ETFs just as they would individual stocks. ETFs are a wise investment if you have a lengthy investing horizon, much as index funds and mutual funds. Additionally, since an ETF share price may be less than a mutual fund minimum, ETFs are the best option for investors who lack the funds necessary to fulfill the mutual fund's minimum investment criteria. Number 8. Dividend stocks. Dividend stocks may provide both the growth of individual stocks and stock funds as well as the stable income of bonds. Dividends, which businesses regularly pay to shareholders, are often linked to dependable, successful businesses. Even while the share prices of certain dividend stocks may not increase as much or as rapidly as those of growth stage businesses, investors may find them appealing due to the dividends and stability they provide. Remember that dividends received in taxable brokerage accounts are taxed in the year they are received. Stocks, on the other hand, are subject to primary taxation only when they are sold. Any investor, from a novice to a retiree, may benefit from dividend stocks, but depending on where you are in your investing career, some may be preferable to others. Number 9. Individual stocks. A share of ownership in a corporation is represented by a stock. Stocks have the greatest amount of volatility while providing the best possible return on your investment. These words of warning are not intended to make you steer clear of stocks. Instead, they are intended to direct you toward the diversity that purchasing a group of companies via mutual funds, as opposed to doing so individually, offers. Investors that are ready to take on a bit extra risk and have a well-diversified portfolio. A solid rule of thumb for investors is to keep their individual stock holdings to 10% or less of their whole portfolio due to the volatility of individual equities. Number 10. Real estate. In traditional real estate investment, a property is purchased with the intention of eventually selling it for a profit or being owned with the intention of receiving rent as a steady source of income. However, there are a number of other, far more passive methods to invest in real estate. Using real estate investment trusts, or REITs, is one such method. These are businesses that hold assets that generate money, such shopping centers, inns, offices, etc., and provide dividends on a regular basis. Popularity of real estate crowdfunding platforms, which often aggregate users' funds to participate in real estate projects, has increased recently. Investors searching for further diversity in their investment portfolios are those who are prepared to take on greater risk in exchange for greater rewards. Investors shouldn't invest any money they may need to access fast since real estate investments are very illiquid. This is all for today's video. What do you think of our video? Feel free to express your ideas in the comment area below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.